What's up, everybody? Welcome back to the stocktrades.ca YouTube channel. My name is Dan Kent, one of the co-founders of stocktrades.ca and one of the founding partners of Stock Trades Premium. In this video, I'm again going to divert away from speaking on the best individual Canadian stocks and instead focus on a really challenging concept for a lot of Canadians, and that is dividend taxation. The dividend tax credit, how it works, and how you can expect to be taxed on your dividends in a non-tax sheltered account. There was a ton of positive reaction, even though it didn't get the most views on our video on the best dividend payout ratios and which ones to apply in particular areas, and a ton of you reached out to me and asked for more educational dividend-based content. So in this one, we're going to speak on dividend taxation in Canada and how you are getting a huge benefit by owning Canadian dividend stocks as a Canadian resident or Canadian citizen. Let's go. So in terms of dividend taxation, if you're sitting here thinking, well, I only have an RRSP or a TFSA and I haven't maxed them out yet, so this video isn't really for me, it's very important to understand that the end goal should ultimately be to max out those accounts, and essentially you're going to have a taxable account that is earning you income and capital gains as well. So the dividend tax credit is a very important thing to understand, and a lot of people think that it is pretty much unfair the way they do it, but in reality, you're getting a huge advantage, and I'll explain why that is later. But first, I kind of want to explain how dividend taxation in terms of the grand scheme of investment taxes works and how it's kind of the middle of the line in terms of benefits with taxes. So in terms of taxation, the worst taxation you can endure is interest income. That is because it is taxed at 100% of your current income. So if you make $1,000 in interest income, say from a bond, you will be taxed your nominal tax rate on that money. So $1,000 in interest income and you're in, say, a 30% tax bracket, you will be charged $300 on that interest income. But if you have, say, capital gains, you make $1,000 in capital gains is only taxed on 50% of your capital gain. So let's say we make $1,000 in capital gains, 500 of that is taxable at our 30% tax rate. That equals $150 in taxes. That is half the rate of interest income. And if we move forward to dividend income, which we're going to speak about, and I'm going to tell you step A to essentially the final taxation of your dividends. Dividend income comes in between interest income and capital gains. You will pay more taxes on dividends than you would capital gains, but you will pay less taxes on dividends than you would interest income. So in order to figure out how dividends are taxed here in Canada and how they truly are a tax beneficial way for people to earn income, we have to understand what the dividend tax credit is. And one thing I do want to reiterate is that this is for dividends paid by a Canadian corporation only. Dividends received by foreign companies, such as owning US stocks, are subject to full taxation. And this is really going to make sense when you figure out that Canadian dividends from Canadian companies are paid with after-tax profits. So the company, say TELUS, say BCE, say Enbridge, they're paying income tax to the Canada Revenue Agency before they pay you that dividend. So the government is giving you a dividend tax credit in order to avoid double taxation of that money. And how they do this is they gross up your dividend income, as they call it. So this is essentially what the CRA does to emulate the income that you would have been paid had the corporation not paid income tax on that money. So let's look at what dividend gross up is, and I really need you to bear with me during this portion because it is going to seem like you are being treated extremely unfairly when it comes to the taxation of dividends here in Canada, when in reality it is a huge benefit. So for right now, and it's very important that you understand that the time you're watching this video might not be the same in terms of dividend gross up or even any of the tax numbers calculated inside of this video. So it is absolutely imperative that you check the recent tax rates, or you get a qualified accountant to do your taxes and you're simply watching this video just to learn. So dividend gross up, it is currently 38% on eligible dividends and 15% on non-eligible dividends. So the difference between eligible and non-eligible dividends, the only thing you really need to know is, for one, the company must tell you what a dividend is. You do not need to search for this information yourself or figure it out yourself. And secondly, eligible and non-eligible, it just means that the corporation paid less taxes on the non-eligible dividends, and as such, they are qualified for less of a dividend gross up. So eligible dividends are a 38% gross up and non-eligible are 15% dividend gross up. So let's look at a situation where we have on one end $1,000 in eligible dividends, and on the other hand we have $1,000 in non-eligible dividends. We're going to take that $1,000 in eligible dividends and we're going to times it by 1.38 to get $1,380. And for the non-eligible dividend situation, we're going to take that $1,000 and we're going to times it by 1.15 to get $1,150 to get the total dividend gross up of the non-eligible dividends. Now, this is the dividend income that you're going to be taxed on, and this is where so many people get confused. They're sitting there thinking, I've made $1,000 in dividend income, but I'm getting taxed on $1,380. How is this even fair? And again, I can't reiterate enough, it is going to make sense as I walk through this, so keep watching. We now need to calculate your dividend tax credit. And for the purposes of this video, I'm going to stick to federal dividend tax credits only because I know we have a wide audience here in Canada and I don't want to mislead anybody on provincial dividend tax credits. If you want to learn your provincial dividend tax credit, just look up the current tax rates of your province. The calculation will be much the same as I'm showing you right now. It's just on a provincial level, not a federal level. So as of right now, the dividend tax credit on eligible dividends federally is 15.0198%, and on non-eligible dividends it is 9.031%. But again, to make this really simple to calculate the dividend tax credit, we're going to speak on an eligible dividend only, as the vast majority of the dividends you are likely to receive will be eligible for dividend tax credit purposes. So we're going to take our $1,380 and we're going to grab 15.0198% of that. That is the federal dividend tax credit on eligible dividends right now at the time of filming. And this is going to give you a federal dividend tax credit of $207.27. So overall, we're going to figure out our dividend taxation on the $1,000 in eligible dividends. We're then going to subtract our dividend tax credit, and that is going to give us our total taxes paid on our dividend income at a federal level. So if there's one thing I can guarantee at this point of the video, especially if you aren't really that comfortable with the dividend tax credit, and that is that you are still extremely confused right now, and I'm going to put all that to bed with an in-depth example. We're going to look at a combination of eligible and non-eligible dividends and a particular tax bracket to figure out how much income tax we're going to be paying on our dividends, and how this dividend tax bracket is truly beneficial, even though it looks poor on the surface. So let's get the example started. Let's say we have John and he has received a total of $1,000 in dividends. 800 of them are eligible and 200 of them are non-eligible. And let's assume that John is in a high tax bracket with his nominal tax being 30%. So first, let's gross up the dividends, and we have $800 in eligible dividends. And if you remember, the dividend gross up for eligible dividends is 38% at the time of filming. So we're going to take 800 and times it by 1.38 to get our $1,104 in eligible dividends grossed up. And we're going to go to the non-eligible, and if you remember, the non-eligible gross up percentage is 15% right now. So we're going to take that 200 times it by 1.15 to come up with $230 in non-eligible grossed up dividends. We're going to add both of those together to come up with our total taxable dividend income of $1,334. So with John being in the highest tax bracket, he will pay 30% on this grossed up dividend income, or $400.20. Now, this is where a lot of people get confused again. We have $1,000 in dividend income. John is in the 30% tax bracket, yet he's paying $400, or essentially 40% on his dividends paid. But we haven't applied the dividend tax credit yet. So if we head back, we have to figure out our dividend tax credit. And again, I'm speaking only on a federal level in this video. So the dividend tax credit on eligible dividends at the federal level is 15.0198%, as we discussed before. So we take 15.019% of $1,104, which is his grossed up eligible dividend income, and we come out with a tax credit of $165.81. We are then going to take 9.031%, which is the non-eligible federal dividend tax credit, and we're going to take that from $230, which is his non-eligible grossed up dividend income, and we're going to get $20.77. Now, we're going to take both these $165.81 and $20.77. We're going to add them together to get a total dividend tax credit of $186.58. Now, another tripping point here, another area where a lot of people get confused, is they take this $186 in credit and apply it to their total taxable income, their total grossed up income. But this doesn't work this way. This dividend tax credit comes off of your taxable income. So if we take from the example, John had $400.20 in total taxable income. We're going to subtract the $186.58 from that to come out to a total amount of taxes due of $213.62. So now it's starting to look a lot more attractive, right? We have John in a 30% tax bracket who is paying $213 in taxes on his dividends. That's only a 21% tax rate, showing you the benefit of owning Canadian dividend stocks when applying this tax rate. Initially, the gross up looks really bad, but after we come to the bottom end and figure out the actual amount of taxes we're paying, it is extremely beneficial. And it's going to get even more beneficial, as I'm going to show you next, when you are in a lower tax bracket. So now you probably have a lot clearer picture on how the dividend tax credit here in Canada works, but we aren't done yet. In fact, I haven't even gotten to the most tax beneficial point of this dividend tax credit, and that is the fact that lower income earners benefit significantly more from the dividend tax credit. And to highlight how this works, let's look at an example. So let's assume from the previous example that all the conditions stay true, and I will highlight them on the left-hand side of the video here. John was in a 30% tax bracket. He had $400.20 in taxes due on his dividends, and he received $186.58 in dividend tax credit for total taxes due of $213.62. But we're going to change one critical element here. We are going to change John's nominal tax rate to 18%. So again, John's grossed up income stays the same, $1,334. But what is key here is he will only pay 18% tax on that $1,334, or $240.12. And if we highlight again, his dividend tax credit doesn't change. So he still qualifies for $186.58 in dividend tax credit. So his total taxes paid are $240.12 in taxes due, minus the $186.58 in dividend tax credit, for total taxes paid of $53.54 on $1,000 in total dividends received. This is a total tax of 5.35% on your Canadian dividends. So not only is this a significant savings from what you would pay if you're in a higher tax bracket, but overall, we can see that John went from 30% to 21% in terms of total taxable income, when he was in the higher tax bracket, but he went from 18% to 5.35%, which is significantly lower in terms of overall tax reduction. 5.35% on your income, your dividend income, is a ridiculous price to pay in terms of income taxes. And this is why a ton of retirees here in Canada own Canadian dividend stocks in their taxable accounts, because often in retirement, you're in a lower tax bracket and you can take advantage of this huge dividend tax credit that the government gives you. So before we close out the video, I just want to explain one more thing, and something that stumps a lot of investors, and that is REITs, or real estate investment trusts, or any type of units, essentially. On most financial sites, you'll see that they have a dividend payout ratio and a dividend yield, when in fact these trusts are issuing a distribution, not a dividend. And this distribution can contain a wide variety of total payouts. You can see return of capital, you can see capital gains, you can see dividends, all inside of one distribution. But what I'm really trying to say here is the dividend tax credit really doesn't apply to a real estate investment trust, in the fact that you can't just take their distribution and apply the dividend tax credit to the whole distribution. And you can run into something like this on split corporations or income funds as well. But what you really need to understand, and I really can't stress this enough, is that these types of taxable situations are best left in the hands of an accountant. I've known a lot of people who've attempted to do their own taxes in this regard, and they've ended up getting in a lot of trouble. So get an accountant to look at your tax situation and get them to figure out how you're going to be taxed, especially when it comes to complex investments like split corps, like real estate investment trusts, like income funds. But that's pretty much the end of the video. I really hope this helped you at least shed some confusion on the dividend tax credit. It might take you a few watches of this video to fully understand how it works, but this is something that stumps a lot of investors, and we've received a ton of questions on it before, so we decided to make a video on it. And I also have an accompanying article over at stocktrades.ca. I'll drop a link in the description if this might be more clear to you reading rather than watching. And again, smash that like button, head down below, subscribe to the channel for more great Canadian content, and we'll see you next time.